Hey guys, welcome back to the channel. This is Shuril and you're watching Modest Millennial, where we talk about all things money that they don't teach you in school. And today, just like the past few weeks, we are back with financial independence and retiring early, the subreddit on the popular forum Reddit, where random people post about their fire journey or how to get started with fire journey or how they are doing with their fire journey. And we are going to be reacting to some of these posts. I know you guys have shown a lot of interest in my previous videos, so I'm sure this will be a spicy one as well. So without further ado, let's see what some of these people have to say, and let's jump into these posts and try to react to them and see what people have to say. Before we jump in, of course, I'm not a financial advisor, so all of these things that I'm going to be saying in this video are my personal opinions and come from the standpoint of what I would do if I was in the position of the author of the post. So whatever I say, definitely do your own research, talk to your financial advisor, your CPA, before doing whatever I say in this video. All right, let's jump in. So I'm sure you can see this subreddit on my forum here. I've for this time I've already clicked on some of the posts, and I'm going to open these up one by one. The very first one I have is what's next. I'm 25, making six figures, broke up with my girlfriend of 3 years, and I'm 100% remote and just ended my lease. I'm free as a bird. What should I do next? I saved up $50,000 last year. Want to make my first million within the next few. Okay, great. So 25 years old is a pretty young age. Making six figures at 25 years of age, that's amazing. That's great income. Not a lot of people have that sort of an income. I think the average income in the United States per person is like $36 to $40,000. So making six figures at a very young age, that's a significant amount of money coming in. 100% remote. That means some of their costs are definitely lower. Their transportation costs are lower. They don't have to spend money on gas every single day, going to work and coming back from work. So that's great. Um, they have saved up 50K out of their 100. Let's just assume the income is 100K, right? At six figures, they have saved up 50K, which is what, 50% of their income, which is great as well. And now they want to go ahead and try making their first million in the next few years. So yeah, so I think this person has great potential, in terms of where they can be in life, and they can do a lot of things actually. So I would imagine, since they're making six figures from their job, their company probably offers a 401k. So I would start with that. Basically with a 401k, you get an employer match. So if you're contributing a certain amount, your employer will contribute up to a certain percentage of that amount, or of your gross income, um, whatever the company policy is, and that's pretty much like free money, right? So if the employer matches, say, 5%, if you put 5% in your 401k, that's pretty much already 100% return on your 5% that you're contributing to the 401k. Plus, on top of that, all of that money gets invested in the market. So whatever you are making on top of the employer match, that's pretty much coming in as all of it is free money for you to enjoy in your retired life. But of course, 401k, with the traditional one, you cannot access those funds until you are 59 and a half years of age. And this person is trying to make $1 million within the next few years, meaning they're probably on the path to fire. People that are trying to achieve fire, they try to achieve financial independence early and retire sooner than the average retirement age in the United States. So I guess what they could do is, outside of their 401k, they could start by investing in a Roth IRA, depending on what their income is. And with the Roth IRA, there is definitely a cap of $6,500 every year that you can invest in the Roth IRA, and that money pretty much goes tax free. So all of the money in the Roth IRA, if you don't touch the money until 59 and a half years of age, all of that money after that age point, it's going to be completely tax free. So the money going into the Roth IRA is definitely post-tax, because you're putting money after receiving your paycheck in your bank account. But as long as the money has been in the account until you're 59 and a half years of age, and whatever capital gains you have earned on that money in that account, everything is going to be tax free after almost 60 years of age. Let's just call it that. The only caveat with that is, for the first 5 years, you cannot touch any of the money in there. Otherwise, you will be I think you'll be charged with like a 10% penalty for getting any money out. You can definitely take your contributions out, but you cannot take profits out. And if you touch any money after that until 59 and a half years of age, you will be taxed, depending on your tax bracket on the capital gains portion of it. So the Roth IRA is a great way to look into. The other one is if you're looking for $1 million in net worth in a few years and not just $1 million in cash invested. With the kind of income they're bringing in, they could potentially look into getting into the real estate game. Try and buy up a fixer-upper sort of fixer-upper sort of a property, and maybe put some money into it, not a whole lot, some money into it, and try to fix it, and try to either flip the property for a decent profit or rent it out, so that while you are getting rent, you're also you rent income, you're also building equity into the home because somebody else is paying for your mortgage at this point. So there is a lot of people on YouTube that make videos about real estate and rental income and all those things. So definitely check those out, and let me know what you think about getting into real estate. I guess the other two things I would do is, if you have any, or if they have any money left over after doing these certain things, they could definitely start a brokerage account and start by investing in some of these index funds that track the S&P 500. They generate on an average 8 to 10%. Obviously, it's not going to be that you'll be a millionaire in 5 years, but within a certain amount of time before you reach a certain retirement age, you will definitely be a millionaire, right? And then, of course, I personally invest in cryptocurrencies these days because Bitcoin, Ethereum, all of these things have shown significant promise in the past 10, 12 years. Everything has been up, double digits in terms of percentage amount for the past 10 years, which is much higher than what the regular market, the stock market does. And because of that, I think I still have faith in Bitcoin. I'm not throwing my life savings into it, but still probably 4 to 5% of my portfolio is invested in Bitcoin and Ethereum at this point. So that's another thing to look into. In terms of expenses and how much money they are investing, probably best to look at what you're spending every single month. So if you're living in a Okay, they just ended their lease, which is good. So they could look at pretty much what's called house hacking, wherein you can get a house and you can rent out portion of the house since you're living by yourself. You probably don't need the entirety of the house, and generate rental income from the rest of the house, where the rental income first of all is paying off or paying for your monthly mortgage, and then secondly it's making you money after paying for a mortgage that comes into you as your passive income or as your profit every month that you can again start investing, and that can be sort of a supplemental income to your $100,000 or whatever the six-figure income is every single year. In terms of other expenses, I guess let's just have the transportation costs as low as possible. Just drive a beat up car since you don't commute to work that much. I don't know what sort of a subdivision or what sort of an area you live in, but if you have public transportation, maybe make use of that as and when you need, so that you don't have to own a car. And then keep your expenses as low as possible. Maybe eat at home as much as possible. Lower your subscriptions, and all of these things definitely help you save up some extra amount of money that you can then throw into your investment accounts, and um, that can help with they can help all of that money can help with growth and retiring sooner or achieving financial independence. So there you have it. So let's see what else we can find, and definitely feel free to like this video and comment down below with your thoughts on fire and where you are in your fire journey. Or if you haven't started fire, I definitely have a video coming in later this week that talks about what fire is and what people that want to achieve fire do with their finances. So definitely check that out later on in the week. So, all right, the next post we have is, how much of your income do you spend on mortgage? Hi there. I'm currently living in a city with a very competitive real estate market. I guess the real estate market is competitive pretty much all over the US at the moment. It's just, extremely expensive. My fiance and I are looking to buy a home together, but I've been unable to get over how much we are going to spend to get what we want. the down payment doesn't scare me as much as the monthly mortgage does. For a house that meets our needs, we're looking at a $3,500 to $4,200 dollar per month mortgage, which seems really high and daunting. Our current income before taxes is around $267,000, which is great, and we project it to increase another 40K next year. I've read about the 28% rule and all of these other DTI factors. But I'm wondering from personal experiences how much others pay on their mortgage. Is a $4,000 mortgage is manageable for our income, or am I crazy? Let's do a quick calculation here, right? So 4,000 times 12 divided by 267,000 times 100. Okay. So the $4,000 per month comes out to about 18% per month in mortgage payments, which is not ridiculous. There's definitely much higher payments out there. Much lower payments as well. I'm not sure what area you live in. I don't know if it's a high cost of living or a moderate or a low cost of living area. Um, but since you're saying for a house that meets your needs, 3,500 to 4,200 is what you're looking at paying roughly. I think with $267,000, that's a decent amount to pay towards mortgage. I'm not gonna say it's cheap. I'm not gonna say it's living modestly or living below your means, but it's definitely living at your means, not going way beyond what you can afford or what you can spend. The Basically this post also talks about the 28% rule. So the 28% rule is pretty much you can afford to pay 28% of your income towards mortgage every single year. So it's as simple as that. We saw that the 4,000 comes out to what, about 18% of the 267,000. So they're definitely 10% under the 260 under the 28% rule, which is great. Personally, I'm a fan of living well below your means, and that's what is needed to achieve fire. I'm not saying that these guys won't achieve fire, because um, their income is so high that even with $4,000 towards mortgage payments, they can still put away a lot towards retirement and still try to achieve fire, you know, as soon as possible. Probably won't take more than 10 to 12 years. The down payment, they're saying that the down payment doesn't scare them as much, which is a good thing. Of course, this person already has a certain amount of money saved up, and they can use some of it towards a down payment, which is good. I think interest rates definitely are significantly low right now, so it's probably worth taking advantage of that, because once the interest rates start going up next year, the $4,000 in mortgage every month will probably go a little bit higher. You will have to shell out more out of your pocket to be able to afford the same amount of home or the same size of home. If you get what I'm trying to say there. Um, but yeah, I think over the long run, I think real estate, we have seen in the past 20, 30 years, it has been doing great. Over the next 20, 30 years, I would imagine real estate keeps doing pretty much the same thing. It keeps going up. So even with that amount of mortgage payment every month, you're probably still building a decent amount of equity in that home. And I think it should work out fine. I think as long as the house is meeting your needs, as long as you and your fiance both like the house, and that's going to be something that you live in for a long time, not something that you buy and try to sell in 2 years, because then it's probably not worth it. But as long as you like it and you're trying to live in it for a long time, I think it's a decent place to be at, considering you're making that much money every single month. Plus, you also said that um, your income is expected to go up about 40K next, so that puts you right at 300,000. So your 4,000 mortgage goes down even smaller than the 18% of your gross income that we talked about earlier. So I think that's a decent place to be. I think with both of your incomes, I think you guys will be fine with the $4,000 mortgage. But definitely do your own research and do your own math before jumping into this. And let me know how it turns out. Right? Let's try and look at another one here. It's sort of a long post, but let's try and read this quickly. 31 female single mom looking for advice. Okay. I know I could be doing better with my investments since I tend to play things very safe. So I'm looking for advice as to what I could do better. I want to preface this that I live in a very low cost of living area, and that's good. And I have to stay here for the next 13 years for my daughter. Currently, I make $74,000 a year. I have 95K in a 401k, 37K in a Vanguard IRA, 12K in VOO stock, 42K in savings. So right off the bat, I think from an investment standpoint, from where their money should go, I think they pretty much know what they're doing. So this is not a bad place to be. With being a single mom and making 75K a year, I think that's a pretty decent spot to be in. In terms of expenses, they have $112,000 mortgage at 3.375%. Monthly housing expenses come out to around 1K with insurance, which is not bad at all. Um, Taxes, utilities also, of course. Yep, I get that. I own my car and no other debt. I currently contribute 15% to my 401k. That's awesome. I guess I'm wondering what I should focus on next. More into the Roth IRA, 401k, or stocks. Um, as I said, I play it very safe, which is why I have so much sitting in savings. I want to be able to support myself for a while in case I lose my job, especially since I'm strapped to a single geographical area and being close to my kid is important. Okay, would appreciate any advice. Thanks in advance. So okay, so let's take a look at this here. So this person has $42,000 sitting in a savings account. The very first thing, the least, thing I would do, what I would at least do is move that money into a high yield savings account. It's still a savings account with a debit card and everything, but you get more interest on the money you have in that account. Right now, the interest is relatively low. I think it's on the lines of 0.5 to 0.7% a year. But once the federal benchmark rate starts going up, that's supposed to happen end of next year. The interest on the high yield savings account would also start going up, and your savings, which are currently not doing anything at all and losing value to inflation, those savings will start earning interest through the high yield savings account, which is the least you could do with your money. Um, 12K in VO stock is great. I would definitely put more money in either VO stock or through a Fidelity brokerage, or even with your Vanguard IRA in a S&P 500 tracking index fund. Because I think the expense ratio on index funds is relatively lower than ETFs I've seen. Mutual funds, definitely expense ratio is higher, but for the index funds, specifically for S&P 500 tracking index funds, I've seen that the expense ratio is lower than VOO. So maybe consider that. I think the 401k is great. I don't think I would do anything with the 401k because you're already contributing towards it, and you probably know that you cannot touch that money until you are a certain age. So that's roughly 28, 29 years from now for this person. Um, so I would leave the 401k as is. I think you are contributing enough to the 401k, and start focusing towards having moving your savings into a high yield savings account and moving some of that portion into VOO, because I'm not sure if you have mentioned your monthly expenses here, but seems like they're not a lot. Um, yeah, just the car and maybe some groceries, so maybe 2K. So the 42K is 2 years worth of expenses roughly. I wouldn't save any more than 6 months to 12 months worth of expenses in savings account, and I would invest the rest of it in VO. So that comes out to about half of your savings that you should be, or I would move to stock or index funds if I was in this situation. Um, Apart from that, if you want to diversify a little bit more, you could look into real estate. You could buy a small house that you could rent out and use that as passive income. Like I said earlier, there's a ton of videos out on YouTube that talk about rental properties and how to invest in rental properties and how to use that as a source of passive income. So you could definitely take a look at that. Um, Other than that, I really honestly don't have any any other advice for you. You're doing great, and um, what am I supposed to say? You own your own car, which is great. You don't have any other debt, which is awesome. Housing expenses are not that expensive. everything looks okay. I think I would probably consider doing a 529 plan for the daughter, so that you can save some money for her college expenses. 529 plan, basically you are the owner of the plan, and all of the money that goes into the 529 plan, you can invest that money, and your daughter can eventually use that money towards her college expenses. And eventually, if she for some reason doesn't end up going to college, all of that money is basically yours. You pay a little bit of penalty and taxes on it, but it's still a certain amount, a certain mode of investment. Plus, your daughter will thank you when she goes to college and finds out that she has, there's her mom has saved up money for her, for her tuition and living expenses and everything. So I think that's the only advice I can give you there. So, um, good job there, congratulations, and keep moving, keep hustling. And then I guess finally we'll take a look at one more post. This one says here, how are you handling the market dip? And I think before we jump into the post, I would really like to request to like this video below and subscribe to my channel, if you're enjoying this sort of content. And then also let me know in the comments below if what portion of this video you like the best. If you like me reacting to these sort of posts, that's great. If you want me to react to something else, definitely let me know, and I'll put that on my list of things to react to, and I'll get into those videos at some point. Um, but yeah, going back to this video here, it says, how are you handling the market dip while September? So for those of you who don't know, for the month of September, the stock market tends to be negative somewhat. On an average, it has performed at negative 0.5% for the month of September only. And this year for 2021, I think yesterday I saw that. Um, yesterday I saw a news article pop up that said the market dropped by 4% for the month of September. So that's definitely significant compared to all the previous months, because since January up until August, end of August, I think the market had been doing decent. There were a couple negative months, I believe, but not to the extent that September was. So yeah, wild September, I agree. Edit. Okay, today isn't a dip, but for a lot of people who entered into the market recently, they haven't seen a month that is down 2 to 3%. October 2020, yeah, there you go. October 2020 was the last time. So, what are you doing with the market dip? How are you handling it? Throw more money in, changing fund mix, pulling out into cash, buying real estate, real assets, or yeah, real estate, same thing. Do nothing and write it out. So I think my answer for this post will be, throw more money in. Basically, if you take a look at my previous video that talks about the stock market and the economy and just the financial world recap in general for the month of September. There's a segment of the video where I talk about how the market has been low for the month of September because of China Evergrande real estate crisis, and inflation coming out, and a couple other things that happened in the month of September. But my wife and I, we share a joint brokerage account with Fidelity, and we definitely bought in more into the market. We were just saving cash for the last few months, and we threw in all of that cash into the market as the market dipped. Um, so I think that's what I would do if anything like that happens again. If there is another dip that comes in the next few months, I'll just keep saving cash until that happens, and then buy lump sum when that even the tiniest bit of dip happens, because buying in lump sum or over the long term is much better than dollar cost averaging. Um, so I know some of these other things, changing fund mix, I probably wouldn't do that. I'm pretty satisfied with my S&P 500 index funds. They have been performing great for the past 3 or 4 years at this point, and I definitely do not want to change the fund mix. The one thing I did do was, diversified my Robinhood Play account just a little bit more, and I bought into Nvidia, the chip manufacturer company, just because of their potential to support the automotive market in the next coming years. I think the automotive market has been super shaky this year because of the chip shortages coming out of Southeast Asia, and I think Nvidia has a high potential of, kind of stabilizing that shakiness with the automotive market. Pulling out into cash, I probably will never in my life pull out into cash. The only time I'll borrow or withdraw some cash from my investments will be after retiring, when I need money to sustain my lifestyle. That's the only time I'll sell stocks. But otherwise, I'm not selling. I may sell some just to cut losses, or in my play account, I may sell some to either cut losses, or if I find some other better deal or think that something else will perform much better than what I currently have, I may sell that, but I'll directly put money into the other stock right away. Buying real assets, yeah, that's definitely something you can do. I'm not too familiar with the real estate market, or how real estate does, but you can definitely look into that. Do nothing and write it out. Yeah, I mean, if you it's I think do nothing and write it out is better than pulling out of the market or changing your fund mix. If you change your fund mix, you create a taxable situation, because if you're making money and you sell something, you owe taxes on the profits you made from it. So that creates a taxable situation, so you lose money to taxes on it. And then of course, what you buy into next isn't always guaranteed to perform to your expectations, so that's always a risk you are taking. And then also pulling out into cash, that's probably not the best idea, because over time we have seen that cash loses value to inflation. And we have also seen that the market is unpredictable. So it's better to always be in the market. I think Warren Buffett says that time in the market is better than timing the market. So there you have it. So that's all I have for you today. Thank you so much for joining in. Thank you so much for taking time to watch this video. I know it's been a long one, but I think some of these posts that we see from Reddit are definitely interesting, and people have a lot going on in their life. You can always see between different people, there's so many similarities in terms of what they're doing in their finances, but there's so much variation with where they're putting their money, where they're investing their money, and how they are saving or how they are cutting their expenses. um, so yeah, it's always interesting, at least for me, to see what people are doing, and I learn from it. I'm hopeful that you guys learn from it. And if you do, please definitely like this video. Please subscribe to my channel and comment down below about how you enjoyed this video. And stay tuned for my next one. All right. Thank you so much.